Good afternoon, everyone. Dzień dobry. Jestem Patric Gresko. I'm co-leading the venture capital activity of the European Investment Fund. Mówię po polsku, ale nie dosyć dobrze, żeby dokonać całą prezentację po polsku, to będę dalej mówił po angielsku, ale jeżeli macie jakieś pytanie później po prezentacji, to możemy porozmawiać po polsku. So, how many of you actually know about the European Investment Fund? Have you ever heard about it? Good, a couple of them. So I'll spend a bit of time in explaining what the European Investment Fund is, and afterwards I'll give you our perspective on the status of the venture capital market in Europe, because we have very strong indicators telling us that we're on the fast track. So first of all, the European Investment Fund, we are acting as a fund-of-fund investor. We are backed by the European Union, so if you want in a shortcut, we are the venture capital arm of the European Union. We're backed by the European Investment Bank, the European Commission, and some private and public shareholders. But we're also managing money on behalf of certain countries. So for instance, in Germany, we are now managing a pool of money of 1.9 billion euros to support the ecosystem, the venture capital ecosystem in Germany. We've been operating on the market for the last almost 20 years. We start little and then we grew over time. 20 years is a long time. And now we became actually the largest VC fund of fund with more than 300 funds in our portfolio, and having committed today, as of today, having 5 billion euros committed into venture capital funds. Our funds have committed or invested into some 4,000 companies, and we have existing relationship with 170 plus funds across Europe, and actually it goes beyond Europe. So we are allowed to invest in Europe, but we have specific mandates which allow us to invest in Turkey. The European Commission has allowed us recently to invest in Israel, so our geographical scope goes slightly beyond the European Union. So because of our presence, because of our size, we claim to have a 99% visibility. So we see everything which is happening on the venture capital side in Europe. So our main business line or modus operandi is actually investing in VC funds which invest in startup companies. We don't do direct investments, right? But one thing which is really close to our heart and which we really love is investing in first-time team, first-time funds. So partners, ex-entrepreneurs, ex-consultants who are getting together and setting up their first VC fund. That is very close to our heart because it represents 1/3 of our business. Last year we have invested in some 45 VC funds across Europe. 1/3 of them were first-time team, first-time funds. Later on, I'll show you at the end of the presentation what actually the financial outcome is of supporting those first-time team, first-time funds. And finally, we like to be the first mover, the first mover in certain technological areas. We were the first LP to support a cybersecurity focused fund. We have brought the Paladin guys from Washington to Europe. We were the first one to invest in an open source focused fund. At that time, that was OpenOcean. We were also the first one to venture in Turkey with EBRD or IFC. We were also the first one to invest in private equity players in Central and Eastern Europe, and actually, as of today, we're one of the first institutional investors who have invested in the Polish market. As some of you might know, we have committed to Innovation Nest that was announced last week. So we've been operating for quite some time with a lot of patience. We had to wait for seeing visible results of our efforts, but today actually the mood is really positive, and the objective of that presentation is to transmit that enthusiasm, that EIF that I and my team have for the future of venture capital. So the first thing that we're observing, this is a very nice slide that we like from Holzbring Venture, is that there is a virtuous circle being built in the European ecosystem. So what we're seeing is entrepreneurs who are becoming successful. They're becoming repeat entrepreneurs, so they have more experience, they have more money. Some of those repeat entrepreneurs are becoming business angels, so they don't create companies anymore, but they invest in companies and they coach younger companies. And some of these business angels are also eventually becoming a venture capital fund manager. So nowadays, there is a growing number of VCs who are not just a bunch of consultants or ex-corporate guys who are investing in portfolio companies, but these funds, those partnerships comprise ex-entrepreneurs, and that provides a quite strong added value for underlying companies. So, and because these funds are becoming more and more mature and more intelligent and much more and more smart, they're generating more capital. And because they're generating more capital, that allows them to think bigger. And hence, thinking bigger allow bigger exits and better returns for the fund manager. And hence, this is attracting talent to the venture capital market. Actually, the big financial companies like Barclays, etc., Morgan Stanley, are now struggling for talent because a lot of the MBA guys or engineer guys who used to be attracted by the high salaries of Morgan Stanley are actually thinking now about joining a VC firm or setting up their own company instead of entering into a big corporation, a big financial institution. Another angle to look at it, and looking at what is booming on the European market, is the number of exits which are exceeding $100 million. This is what we have collected as information for 2015. There is roughly 35, 36 companies on that slide, so companies which have either been exited through an M&A process or an IPO. When we looked at it in 2015, we thought, okay, this is the peak, 2006 will not look better. When you look at 2006, it does continue. Maybe a bit less IPO, more M&A transactions, and more M&A transactions of valuation which are exceeding $100 million. We haven't managed to collect the information yet for 2017, but the indicators that we're having shows that we're following that fast track and that intensive track of European companies being managed to exit with a valuation of more than $100 million. I'm talking here about exit. The next slide is about exits. The next slide is actually about fundraising. So it's not companies, European companies, being exit at $100 million valuation. This is far away from the unicorns that Pasha was talking about. These are companies which are raising in one single round $100 million financing round for those companies. This is not happening in the US, right? This is happening in European companies. You see Spotify is European companies, Sigfox in France, Farfetch in London, but also in Portugal. So we are coming to a level of maturity where our European companies are really thinking big and are looking for very large financing rounds going beyond $100 million. Again, another allusion to Pasha's presentation earlier, this is the number of unicorns that we have in Europe. We're talking about European-based companies which have reached in some time of their lifetime the crucial valuation of $1 billion companies. A way to look at that slide, if you look on the left side, between 2005 and 2009, there was a handful of those companies, and there was one company which was the reference, which was Skype. We're talking about Skype for 5, 6, 7, 8, 9 years. It becomes a kind of recooked, réchauffé story. We're talking always about the same company. But since 2009, we've seen a growing number of European companies which are reaching this critical milestone of $1 billion valuation. And has been growing year by year. My chart stops in 2015 because I didn't have to adapt this slide. In 2016, we have had companies which have reached that $1 billion valuation. And it is important. And it is really important, notably for a region like Central and Eastern Europe. On those slides, you will see that on the top right, there is a company called Allegro, which is familiar to you. There is another one there on the right side, which is a CD Projekt Red, which is another Polish company. These companies are billion-dollar companies. They have reached that milestone for Allegro for already quite a while, but it became quite public in the course of last year. CD Projekt Red managed to reach that $1 billion valuation on the Warsaw Stock Exchange. I tell you that this is important because it has a kind of a marketing effect. It brings the spotlight on the Polish market. I'm operating out of Luxembourg, operating in a team of close to 40 investment professionals. I'm from Polish origin, so I have a keen interest on what is happening here. I can tell you when I found those information about these two companies reaching $1 billion valuation, well, I was quick to share that information in my VC team, and the guys told me, Patrick, you got your figures wrong. This is Polish zloty. It cannot be a $1 billion valuation. This is 250 million euros. I said, no, guys, and I had to share with them the articles and prove them, with facts that these companies were indeed unicorns out of Poland. I can tell you that it has quite an impact on the mindset, on the focus of the rest of the VC team about the Central Eastern European market and the Polish market. This is actually how it looked like 3 years ago. So T-3, you can see that the number of billion-dollar companies was much more scarce, and what we have seen over the last 3 years was quite an intensifying growth of billion-dollar companies. We're talking about unicorns. It's very nice. It's important, as I've mentioned that. But we, as investors in funds, we prefer dragons. And what are dragons? Dragons are companies which, when they're exited, they return the total fund size. So when we invest in a fund, typically EIF commits, let's say, 20 million euro in a 50 million fund. We're looking for a 2 times return, right? So we're looking at the fund to generate at least 100 million of proceeds to the investors. If you have a unicorn with a 50 million fund size, most probably you will end up with what? 1% of that company? 2%, because you will not be able to follow on in the financing round of those companies. You will be significantly diluted, and 1% of 1 billion is 10 million euros. So when you have a 50 million euro fund and you have a unicorn in your company and you exit and you return 10 million to your investor, I mean, you can go on a conference like here and say, hey guys, I have a unicorn in my portfolio, I'm a great investor. But you go back on the fundraising market and you talk to investors like us and say, wow, super cool, where is the rest of the money? We're expecting 2 times return. You have returned 10 million with your unicorn, we're expecting you to return 100 million before you start talking to us. So that's why we have to be very careful in the management of the portfolio of funds. Unicorn is very nice, dragons are much more important. This is a chart to tease the other business line of EIF. So in yellow, you see the valuation of the evolution of the valuation of our VC funds since 2010. So we have reset the clock in 2010, and we have compared that to the valuation of the funds which are called mid-market. This is the other business line of EIF. So at EIF, we invest in VC funds, but we also invest in private equity, like, for instance, enterprise investors here in Poland. And we start doing that in 2006. We start investing in 98, 99 in venture. In 2006, we look at the financial results of VC, and it scared us a little bit. It scared our board, so we convinced our board that we should be looking at private equity. So we have established a unit investing in private equity funds, and those guys actually were looking at us, and they were saying, yeah, guys, you're doing the fun stuff, innovative stuff, technology. This is super cool. We're making money, so we're subsidizing you. You're there thanks to us. And nowadays, it's not the case anymore. We continue doing the cool stuff. We continue backing very cool fund managers who are investing in very attractive and innovative companies, but we're doing that in a lucrative way, and I'll explain you later and give you some more details. So this chart allows us to compete, if not close the mouth of our colleagues from the lower mid-market, but it's a chart more for teasing our colleagues internally. Let's do, I won't say a deep dive, but some dive into the financial returns of the investments that we have been doing on the VC fund. So I have looked at funds which have raised from 2007 to up to now. I think it's a population of 150, 160 funds. If you look at the top 10 performers of these funds, so you take the number top 10, the best performing generates a 66% net IRR, which is not bad, right? This is really exceeding the expectations as an investor. When you look at the number 10, it's a performance of 33%. You would say, okay, but you have to be damn selective, right? It's only 10 funds out of a portfolio of 160, 170, with a median of 46% for that one. When you look at top 10, if you had invested in the top 10 best VC funds in our portfolio, you would have a range of a net IRR of 23 to 66%. And if you look at the top 30, you're still in the double-digit net IRR. So if you had invested in the 30 best funds of ES portfolio over time, you would have a median IRR of 27%. And that is done, and I forgot to mention that, with two objectives. We are a public institution, so we have a public mission, a public policy to support the emergence of strong and solid venture capital asset class, but at the same time we're doing that with an objective of generating a risk financial commensurate return. And that is the proof that actually we're not only fulfilling our policy mission, but we're doing that with financial returns at the end. So the conclusion on that one, on that small deep dive on our portfolio is that European VC is not a loss-making machine. European VC can be done very profitably. We're seeing a number and a growing number of double-digit and even single-digit but profitable venture capital fund managers. But we're also seeing that on the fund-of-fund level. So as I mentioned, we're a fund-of-fund. We have money from the EIB, we have money from the European Commission, but in Germany, for instance, we have a specific national mandate. The German Ministry of Economy has entrusted us, I think it was in 2006, almost 10 years ago, with a 500 million mandate to support the German VC ecosystem, which was almost inexistent 10 years ago. That mandate has now grown to 1.9 billion euros that we're managing on behalf of the German Ministry of Economy, and in the next slides I will show you the results of that fund of fund. The other message is that the VC model is not broken, because we're talking about paper value. There is a lot of criticism that all the valuation that I'm presenting to you here is still unrealized. We are seeing on certain of our fund of funds that we're managing that we have a distributed to paid in, which is above 1. So the overall effect of that is that for the best VC fund managers, those which are able to show cash-on-cash results, the fundraising is getting easier. And this is another sign that venture capital is coming to a certain level of maturity on the market. 5-6 years ago, even the best VC funds in the hubs in the UK, in France, in Germany were struggling for their fundraising. We're seeing a growing number of fund managers which are not only hitting their target size, but they're also reaching their cap size. So ERP, that's the German mandate. This is the results that we have achieved. It's something which has been created in 2006. This is rolling net IRR. We have a minus 2.8% net IRR because we keep on investing a lot. So the short-term horizon is negative. But the 3-year net IRR is beyond 12%. The 5-year net IRR is close to 10%. And since inception, we have generated a 5.6% performance on the fund of fund with a public mission. So I think that is quite of an achievement that at least at EIF we're very proud of. We have not only reconstructed the German VC ecosystem, is one of the most, if not the best, well-functioning one in Europe. It is competitive with the UK market. We have participated, we have a big deal, a big responsibility in that, but we have also been able to do that by making a profit for our shareholders. This is the last slide of my presentation. Hopefully you're not colorblind. It takes a little bit of time to understand that. But basically the verticals are the vintage years. And the numbers on the left are each time the top 5 best performing funds per vintage. And where you should focus on is on the dark green. The dark green colors are the first-time team, first-time funds. So each time you see a dark green square on that chart, that means that there is a first-time team, first-time fund being amongst our 5 best top-performing fund in that vintage year. So in 2006, out of the top 5, we have 2 first-time team, first-time funds. In 2011, we have 3 first-time team, first-time funds. In 2013, we have 3 first-time team, first-time funds. So it's not because you're a first-time team, first-time funds that you are bought for failure, that you will not succeed. And this explains why we are so demanding about first-time team, first-time funds. We love first-time team, first-time funds, as I've mentioned to you earlier, but we're quite demanding. We have a rejection rate overall on our portfolio of some 80%. First-time team, first-time fund, the rejection rate is around 90 to 95%. We're quite demanding. Why? Because we don't want to put on the market fund managers which will not respond to the expectations of the market and not respond to the expectations of the entrepreneurs. We have a great share of responsibility as EIF and as other investors in putting in place on the market well-functioning quality fund managers, and this is why we're spending quite some time in supporting first-time team, first-time funds. Some financial results about that. I looked at the range 2006 to 2013. We have backed 49 first-time team, first-time funds during that period. Out of those 49, 21 today have a double-digit net IRR. I think there are a lot of established fund managers who are dreaming about having a double-digit net IRR. And the median is around 5.6%, so that means that more than half or half of those 49 funds have generated more than 5.6% net IRR, which is unrealized today, so that can still be improved. And let me allow concluding with a couple of words about the mission of EIF and why we're doing that. Our objective is to build a well-functioning venture capital ecosystem. The European market is has not reached a status yet where we could withdraw. There is still a very strong need of a support of public investors like the European Investment Fund, but also national public support like BPI is doing in Germany, like KfW is doing with us in Germany, sorry, BPI in France, like PFR will be doing here in Poland. But our long-term objective is to become redundant. We would dream, and we're dreaming at EIF, that one day we'll be able to stop investing in the market because the market will be so attractive that only private investors would be welcome in VC funds. And the VC funds which would reach that status, they would turn back to us and they would say, Patrick, dear EIF team, thank you very much for your support some 10 years ago, but we don't need your support anymore. And that concludes my presentation. Thank you very much for your attention. I think we have a couple of minutes for Q&A. Don't hesitate to shoot questions. If not now, I'll be around throughout the conference. Thanks a lot.